Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for May 7th, 2016. I have a market that is on the boundary between bullish normal and bull quiet. On an annual basis using weekly RSI 14, we are slightly above the midpoint of neutral at 56 on a 10-day basis, with the 10-day NDX just out of the oversold conditions at 31 out of 100. Looking at the market mosaic, we are green bullish with price with respect to the 200-day moving average at 3%. Slope of the 50 has decayed a little bit to 0.61. That's white bullish. ADX remains neutral with bears in charge at 16, but untrending. The risk index is a 30-period moving average of the VIX divided by the 10. The boundary between risk on and risk off is 1.0. The current reading is at 0.961, so we are into risk off conditions. Take that score of 0.961 compared to the last 5,000 trading days. We find the average and standard deviation to compute the risk Z, which is we're right now at minus 0.54. Here you see a 90-day histogram of that indicator coming down from 2.4 when life was easy. It has slid now to a lower high and now dipped into dangerous territory here for volatility events at minus 0.54. This is an important test of volatility now as we look at the previous hump. These are the holdings for the monthly rebalancing, and these are the leaders of these various portfolios as of Friday's price action. ETF2 remains 100% exposed in the theoretical model and in the model portfolio. Quick look at ETF 13 and 32. Everything's above its 4-month moving average, so we're all in buy positions. There was a broad retracement across the board this week. Gold and the miners and metals and Brazil remain at the top of the stack, although significant retracements occurred in these leaders. It still leaves them up in front, but a serious setback. Some strength in platinum and the MLP high income areas are worth investigating. The S&P 500, again, major smackdown in the commodity areas. These may be some buy a dip opportunities or a signal that the that nice long run in commodities is over. Iron Mountain, Martin Marietta. So there is still some differentiation here in the commodities. FMC Corp is energy. Jacobs Engineering Group, interesting. Vulcan Materials. So again, lots of volatility, which is nice for the short-term market traders. In the market health check, slope of the 10-period regression channel is down, still above the 0 line, but you can see how far this has decayed from the peak, up here around 0.7 down to 8.15. So this is still favorable on the 30, but clearly we've got to find some support here at this double bottom to maintain the earlier momentum from March and April. Got to get above 211 to be a real extension of the bull. This is now a tradable target from current prices around 205 to 212. ETF2 regional report. Latin America remains strong, but the strength in all the commodities has been so focused that by comparison, most of the indices are weak. S&P at 26 is still better than the globals at 22. Inside the U.S., it's mid caps, then small caps, then S&P, then tech. Latin America and U.S. mid caps are the strongest. European 350 and Japan are the weakest. Strength here in the defensive plays in industrials, utilities, and staples. About half the U.S. and all the large caps are below average in the U.S. Mid caps strong across the board. Weakness in Asia and Europe and the countries. Silver, gold, oil, all of these commodities looking good, as is U.S. real estate. Same pattern in the ETF2 lens, looking at the world. Latin America, Brazil, metals and mining remain at the top. In the Dow, Chevron and United Health have rotated to the top, seeing weakness coming into white and then green, with McDonald's, AT&T, 3M, and Caterpillar have rotated off the top. Apple, Nike, Microsoft, Intel at the bottom of the stack. So technology is certainly lagging. Maybe that'll be the tell for the next leg up. We got to see tech kind of join the party. Verizon with yellow and green took a big hit. There may be some value plays there. Just for your reference, the liquidity. Shift into the daily. Plenty of targets on the swing trades in both ETFs and the Dow. Lots of 551W set up by Friday's excellent performance. I take that as encouraging for the long side going into a weekend. Lots on the auto framer to choose from. As you can see, plenty of targets of opportunity. Lots of good frog numbers. And the ETF, also almost the whole stack, looking better than 2-to-1. It's a market condition now. So let's get the market call right and the volatility call right, and then that'll lead us to the positive sectors. Plenty in the auto framer and the RLF to choose from. I'll be looking at Microsoft, Intel, and Apple, since I like to work the bottom end of the curve. The daily squeezes, Travelers jumps out at me as a Dow member. See, the 30-period polynomial regression has rolled over. The slope of the 30 is stalling, still sloping downward, but above zero, and the long-term average. We've managed really to come all the way back to that average without significant sell-offs. It's been more of a slide, a decay, than it has been failure. So this is an argument that the market has fallen back long enough to 205, where support was previously established. You would expect that to happen again. Wouldn't be surprised if it fails. If it fails, it's now one of these runs, another 5% sell-off to 200. But this would be a natural place for it to find support. Just for reference. And this is everything I wanted to cover for this week. As we finish up here with the price at this important support level at the bottom of the river, where it's held one time. Now that sets up this channel from about 205 to 210. The 90 regression line is still strong. The 30 is pulled back to average. The 10 has bottomed out at the bottom of the normal river and starting to curl. So this is the week I think we determine if that bull is going to have legs, or if this is part of the political shenanigans that we look like this choppy period. My gut tells me it's one of these sideways choppies for another, really until the election. The silly season is just about to start, and that will be so much volatility. It's hard to see how you use that as the basis for another leg up. But so we're playing the cards close to the vest. That's everything from Tortoise Capital. Keep your risk measured and your powder dry.